Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Gerish. We are into October, which means the first quarter of FY24 is in the book. So we're going to talk a bit about performance to start and discuss the portfolios that we run through Market Matters. Just a quick overview of performance for September, James. How did our portfolios fare?
Yeah, it was a soft month for equities in September, so obviously a bit of a tricky quarter. So we started June with strong outperformance. We gave back some of that outperformance in August, and then we've come home with a wet sail in terms of September, relatively speaking. So the backdrop of the ASX 200 was down 2.84% in accumulation terms, so inclusive of dividends. But the Market Matters suite of portfolios collectively did better than that. So our active growth portfolio was down 1.91% for the month. Our performance versus the market, but it's still a weak month. We never like dishing up negative performance. The active income portfolio actually did better than the market. Was up 32 basis points, 0.32 of 1%. So it holds equities as well as debt securities, but obviously still influenced by the weakness in equity markets. So pleased with that performance. Emerging companies that you run was up 1.42% for the month, strongly outperforming its benchmark, and a really strong quarter for that portfolio, relatively speaking. And then international equities were down 1.62%, but it was strongly outperforming the MSCI World Index, which was down nearly 4%. So overall, some portfolios higher, some lower, all outperformed the market, Harry, and we're pretty well positioned as we enter the last quarter of the calendar year for 2023.
All right, drilling down a little bit further, the growth portfolio, like you said, it's done reasonably well, was a touch lower in September there. What went right in September, and what sort of drove a little bit of our performance for that portfolio?
Yeah, I'll just give you some broader context around the numbers that have been produced for that portfolio. It's up over 21% for the past 12 months, which is a long way above its benchmark. And over the last 3 years, it's up around 18% per annum for the last 3 years. So this has been a really strong period for the portfolio. Our strategy in this portfolio is around active management of large cap stocks. Clearly been working. We hold 20 positions in that portfolio. The main beneficiaries in the month were Paladin, or main supporting factors of the portfolio were Paladin. That's a reasonably new position we've taken on, PDN, uranium space. A lot of media, a lot of attention around uranium. Uranium prices surged higher in the course of the past month or so. So it's trading up above 70 US a pound. That's provided a great tailwind for Paladin. And Paladin added 94 basis points to the portfolio. Whitehaven was a strong contributor over the month. Treasury Wines also had a good bounce back in terms of their returns, and they added about 30 basis points. Key detractors were gold stocks. So if we think about the backdrop now in this month, the first week or so of this month, gold stocks have really been strong performers. So the overweight position we had in gold in September detracted from performance, is now adding to performance in October. So all in all, really happy with that portfolio. High conviction, large cap, Aussie equities portfolio, actively managed, and it's continued its strong period of outperformance, Harry.
Well, you can say actively managed for all of our portfolios. The actively managed income portfolio is one that we hang our hat on a little bit here at Market Matters. It's been a really strong performer and does what it says it will do and has done for a long time. It was up last month despite a weaker market. Run us through what helped that portfolio outperform.
Yeah, you made a really good point there. So staying true to label is what we're all about, and I think that's really important. So portfolios have different, mandates, targets, strategies employed in them. They all have similar attributes, but tweaked around our asset allocation and the like. So this is a more defensively run portfolio, income at its core, but we retain that active management stance. So as I said, it was up 32 basis points in the month, is up nearly 15% over the past 12 months, and is up 13% per annum for the last 3 years. So the important point about that is around reduced volatility. So that's what we really like in that portfolio. It yields 5.5%, 6% plus franking. So when you gross that up for franking, it's circa 8% in terms of the income that it's producing. As I said, with lower volatility. Key contributors in that month in terms of that portfolio, again, similar to the growth portfolio, we've got Whitehaven Coal there. In terms of the income portfolio, we've got New Hope, which is another coal company listed in Australia, but with a more income bias. They're paying a lot more back to shareholders in the form of dividends and other capital management. That added 54 basis points to portfolio performance. And then some of the hybrid securities that we hold in that portfolio, floating rate, tier one bank hybrids, they had a good month as credit spreads came in. So that was a positive contributor to performance. On the flip side, APA Group, they had a tough month. They raised equity to buy a new asset. They were under pressure as a consequence of that, plus rising bond yields and a few other bits and pieces combined to send that stock lower. But APA Group, it detracted 36 basis points from portfolio performance. That's actually one I'd highlight as a buy down here. So it's been hit for a few different factors, but I think that's now offering value. Historically, whenever it's yielded above 6%, it's been a strong buy. So we think that's the case at the moment.
All right, the smaller cap portfolio, smaller caps more broadly have really struggled over the last little while for a long period of time now. But the emerging companies portfolio delves into that space and it's done reasonably well of late. Just a more broader view of how that portfolio has performed.
Yeah, I mean, capital is more expensive, right? When bond yields rise, when interest rates go up, capital becomes more expensive. Smaller companies need more capital to grow. Therefore, they have more of a challenging backdrop to operate in. Really important around that portfolio that we're the areas of the market to target there are those companies that can fund themselves, and that's what we've been conscious of in the last quarter, if you like. So, that's had a really strong run in the last 3 months or so. It's up 6% on the quarter against a market which has been down. It's about 8% outperformance versus Small Ords Accumulation Index. For the month, it was up 1.42% again, strongly outperforming the market over that time period. And it's it stayed true to label. It's a higher risk portfolio. It's a portfolio that you head up. So it's been more volatile. There's no two ways about that. But it's got some really interesting positions in it. What drove the outperformance, I guess, on a monthly basis as well as the quarterly basis? On
the monthly basis, once again, it was Paladin. It's a stock we've held in that portfolio for a lot longer than we've held it in the flagship growth portfolio. And it's done really well from us. It's also a bigger position in that portfolio relative to the larger cap portfolio. So that was a big portion of the outperformance this quarter and last month. Aussie Broadband as well. That's had a really strong snapback into favour. Had a really good report in August and sort of continued that rally with a bit of help for some broker upgrades in September. And more broadly, I think it was really interesting to see Silex, which does have a bit of a link to uranium. They're building some uranium technology for enrichment there, and that is actually down last month despite Paladin going up. So a little bit of an offsetting factor there. And also Calix as well. It's a really interesting position. It's just like you talked about, funding itself. It's one we've been discussing lately on Market Matters. Being able to fund itself into that period where it's going to be cash flow positive, that sort of visibility is a little bit murky at the moment. So it's a position we're watching closely, and it did detract on performance last month and last quarter.
Yeah, interesting point. I mean, these when we say we're holding primarily businesses that will fund themselves, are still positions in the portfolio that we're bullish on over the medium term, and they've had some challenges because of that funding situation. The international equities portfolio that we run, I'll just touch on this because it was down 1.62% in the month, but it's had a pretty strong quarter. It was up about 2.5% over the quarter. It's done 18% for the last 12 months, which is actually slightly below the benchmark. So it's about 2% below its benchmark, but over a 3-year view, it's done about 14.5% in that portfolio. So we made some changes in that portfolio over the month. We bought Cameco. It seems like this thematic around uranium is as one we've embraced. It's not new to us. We've spoken a lot about this energy transition that's taking hold, and it's going to continue to play out over the coming decades. We think uranium is going to be key to that on a global scale, maybe not so much here in Australia, but on a global scale. And the other stock we added was UBS. That was an interesting one we added a small position in UBS, and added to a existing position that's been under pressure, First Solar, FSLR over in the US. If you want to go and look at an interesting company exposed to the development and increasing use in solar, particularly in the commercial space, First Solar is a really interesting company. It's down about 20%. We're actually down about 20% on that position, but we've added to it because we've got high conviction on that stock. So overall, Harry, I was pleased with the portfolio performance in the month, in the quarter, and if you look on a 1 year and 3 year view for those portfolios, they're going along well, and all of them are tracking ahead of their benchmarks since inception.
All right, now looking ahead, it's what markets do. We're into the last quarter of the financial year, heading into Christmas. It still is a little while away, but the weather's getting a bit warmer. We've had a bit of volatility to start this quarter, James. We've had a bit of a dip. We've started to move out of that. How are we seeing this market into Christmas?
Yeah, I mean, the ASX 200's come back and tested right at the bottom of its trading range around that 6,900 level. Rising bond yields have been the catalyst for that, so we all have been writing too much about rising bond yields, really, and that's been a changing expectations from a market's point of view, more about interest rate cuts. Not as many interest rate cuts going to happen in 24 as the market had priced in. So that has some ramifications about within bond markets and how the yield curve moves. That's put a cap on equities. It's created some selling. We think there's probably value in the market now. We're largely fully invested across our portfolios, positioning for a reasonably bullish move into Christmas. Now, the key to that move is going to be what bond yields do in the short term. So we've got inflation data out in the US very shortly. That's going to be key. So if we start to see, and we've started to see some signs that bond yields are topping out and bond prices are bottoming, if that trend continues, that could provide a really bullish backdrop for equities going into the back end of the year, which of course is a very seasonally strong period for equities, particularly the closer we get to Christmas, the more seasonally strong it gets. So they don't always play out seasonal. So we write often about, the Christmas rally and the like. We're not saying this is always going to play out. It's just more probable to play out than not. So it was a point that we made in the morning note this morning on the Market Matters website. So look, we're bullish on the markets. We've got a large exposure across our portfolios to equities. But as always, we're keeping our eyes open and reacting to what changes across financial markets. As invariably, there's a lot happening out there, Harry.
All right, that's all we've got time for today. I hope you enjoyed today's video. For all information and our daily thoughts on the market, head to marketmatters.com.au.